Hey guys, how's it going everyone? You know what? Before I actually talk about today's topic, let me just quickly wish everyone who's watching this video to stay positive in your mind and negative in COVID. So with this saying, let me just quickly ask you guys if, from time to time you hear those things that the price of, this company's stock is going up, or the market capitalization of that company is reaching $100 million or anything like that. Basically all this fancy and complicated stuff. So that's the reason why today I would like to break down as easy as possible what is actually a stock market and how basically it works. And moreover, we're going to be going through and talking how the price of company stock or all this number in stock market could actually impact the day-to-day real business operation, or do they even impact? So before we actually jump into this beautiful and juicy topic, let me just quickly remind you that this is Accountant is Investing channel, obviously, where I'm talking about accounting and investing and some more things. So that's the reason why do not forget to subscribe for the channel and of course to press that annoying like button as well. So in order to understand that properly and easily, we would actually need to start little far from the topic itself. So let's say that you've got a friend and who's actually very smart and very good at cooking, and actually he has been dreaming about opening his own Italian restaurant. He believes that his pasta is truly delicious, and you know what? One day you see actually him opening that business. He decides to make that beautiful pasta which world has never tasted before. So as time goes by, let's say in a year, he really started doing well, and now he has long queue and people started talking about him and his restaurant in the city. He has a big demand for his products, and obviously his next move is towards expanding his business by opening few more restaurants in the city. However, at the time he didn't have enough amount of money, and so he found an investor who believed in the business, who believed in the restaurant, and was ready to invest. So just to mention you guys, before the first investor involving into the business, your friend obviously was a full owner of the business, so he owned 100% of share of the restaurant. However, to be able to fulfill the increasing demand for his products, he needs to open few more restaurants in the city. So that's the reason why he is ready to give up his, let's say, 20% of his shares in exchange to, again, let's say $1 million. So now we have two owners of the business. One is your friend, which has 80% of the shares, and 20% is new first investor. And obviously, the company itself, the restaurant, has now in its balance or in his bank account $1 million more. So it's not just your friend now owns less amount of shares. Before he was owning 100% of share, now he has 80%, he just owns less. No, but now he owns 80% of the share of the company, which worth for $1 million more. So now, let's say using this financial help, they have opened 5 restaurants in the city, and they're actually pretty popular. And this is where you get into the story. After hearing all those hypes and about the pasta, about the restaurant, you decided to go there and give a try yourself, the product. And you know what? After the first try of that pasta, all of a sudden you realize that it is indeed really good. So you destroyed that pasta and sitting there and thinking by actually finishing your coffee that it would be really amazing to be part of this business, to become a shareholder, as you know that the business has a future perspective, as the product and people who are working there are really amazing. However, you've got a problem. You understand that you've got only additional $1,000 in your pocket, let's say, that you could spend or invest, and you immediately thought definitely your friend would not even consider this amount of money to get you into the business, while his restaurant's monthly revenue is just, let's say $50,000. So your $1,000 would not actually add much of value to the business. So you basically just gave up with the idea in the very first place. So we keep going, and time goes by. Let's say in the next 3 years, the business is getting more successful. It's really killing. Now your friend is very confident in his products, and he actually wants to expand it all over the country, or maybe even go to worldwide. So to accomplish his big huge plans, he would need a lot of money, more money. Let's say that he needs now $100 million. So he started looking for new investors to get this money. However, he was not able to find a person or a couple of persons who would hold such big amount of money at that period of time. Then he went to the bank to get a loan. However, he didn't get the money from the bank for whatever reason. I don't know, either let's say the interest rate was too big for him, or maybe the bank decided that it is too risky business. So at the end of the day, he gave up with getting a loan, and now he has another choice. He decides to go for public, to put some of their shares on the stock market. So the very first time you go to the public, that is called IPO, which is initial public offering. So let me explain you what do I mean by that. So two shareholders of the company, first is your friend and the 20% first investor. So they together come up with a decision to get the money from public, from lots of different people with money around the world. All right, here's the first question coming. How do they do that? So the first thing that they do is actually to go for so-called investment bank. So the second question, what is an investment bank? Well, basically investment bank is intermediary between companies which are looking for money to expand their business or for some other projects. In this case, it's your friend's company and people or investors who have money, who are willing to invest those money in exchange for a piece of those companies. So now your friend has gone to an investment bank and explains to the investment bank that they have a beautiful plan to expand the business, and now they need certain amount of money for accomplishing the plan. And in this case, let's say right now they need $100 million. So they hire the investment bank to help them to get this $100 million to go for IPO, initial public offering. So if before IPO the company was a private, then after IPO company automatically becomes public. However, we have one of the very and main interesting question. So if the company is looking for $100 million to get, which means that they're gonna get $100 million on their bank account. So the balance of company is going to increase. So the question is, how many percentage of company's share the shareholders ready to give to the new investors? I mean, the investors who will be actually giving those $100 million. Would you give a 10%, maybe 50%? Or how do you actually measure those things? So this is where the investment bank helps us. So to put it and explain it in a very simple and understandable way, they start analyzing and calculating how much your company worth at this stage before getting those 100 million, by actually calculating all your assets, such as cash on the bank account, all the equipments that you have, cars, buildings, licenses, your brand, and they're gonna minus all your borrowings, debts, maybe you have some loans. So then they have some sort of net worth of the company. So how much company worth, and also, of course, there will be some negotiation on top of those calculation, on top of this, net worth of the company. They will also, calculate, or they will also take into account company's perspective, future perspective, and how fast company grows, and the product, the uniqueness of the product. So let's say that they have estimated the company, your friend's company, for $1 billion. And just to remind you guys, the amount of money that the company is requesting from new investors is $100 million. So which is a 10% from the company's worth. We have, so 1 billion is net worth of the company, and 10%, that's what we are looking for, which is $100 million. So let's say now we got a deal and we are actually giving 10% of our shares in exchange to $100 million of investment. So now just a little bit of calculation. Now your friend does not own 80% anymore of the company, but he owns 72% because he gave up 10% out of his 80%. So now he owns 72%. And at the same time, with the first investor who had 20%, now he does not have 20% anymore, but he has 18% because he's also giving up 10% out of his 20%. So 10% out of 20 is 2, 20 minus 2 is 18. That's what he has. So you guys could think that this is bad. Now they own less percentage of money. I would not particularly say so. It's not necessarily that bad. Why? Even if your friend now owns 72% of the company, not 80% anymore, but he owns 72% of the company, which worth now not $1 billion, but $1.1 billion. So you see the thing here, he is owning less percentage of the company, but he's owning a bigger company. And now we've got one more very important question. Since we are going public and we want almost everyone to get the access to buy our shares, but there is a little problem. Not everybody has $100 million. So what do we do to make the price affordable for almost everyone? So here is what we can do. So the total capitalization of the company is now $1.1 billion. And so we cut them into, let's say, as an example, for 110 million pieces or papers, whatever you want to call it. So each of those pieces, we will call them stock. So if we now divide the total capitalization, which is $1.1 billion to 110 million pieces, our result would be $10. Well, this is now, our stock price is $10. This is our initial price. So, this is very, very roughly, I'm explaining, I'm providing it, as simple as possible, the process of IPO, the process of initial public offering. So just to clarify, at this stage, company's total capitalization is $1.1 billion. We have 110 million pieces or stocks. We have your friend holding 72% of the company. We have the first investor holding 18% of the company. And we also now have the rest of the 10%, which are listed on the stock market. And, so different people bought those stocks on the public market. So initially, the stock price of the company was $10. So as company will be doing better in the future, showing good performance and nice financial reports, usually, the stock prices also goes up more or less accordingly with, company's performance. So that was basically the idea of the stock market. So now I would like to get back to you. You remember yourself sitting in the restaurant and thinking that it would be really nice and good to buy the shares of the restaurant and be involved into the business. So now you have that opportunity. So you can easily go to the stock market and buy the stocks of the restaurant for a specific amount of money that you had at the time. So if you had $1,000, then you can go ahead and buy 100 stocks of the restaurant with, $1 per stock price. So by the end of this video, to sum up, I just would like to tell you that the idea of the stock market is actually to help both sides. First of all, to the business, to bring the money, investments into the business, by a large amount of people to expand their business, to solve some specific problems, and so on and so forth. And at the same time, to give the opportunity for people who would like to become part of the business and help them, to become shareholders of the business. So that's basically what it is all about. So I hope you guys really liked the video. Please Do not forget to subscribe for the channel, as in the future I'm going to be making more of those type of videos. Thank you very much. Have a good one and stay safe. Thank you.